All right, guys, I'm just testing the voice right now. We're going to start. We're live on LinkedIn, TikTok, Instagram, YouTube. I believe Facebook. Yes, Facebook as well. We're going to be talking about construction loan. Last week, we tried to do that, but it didn't work because of the technical problem, especially, I think, on LinkedIn, but it worked on other channels. We have a lot of followership on LinkedIn, so we want to do it again. Same program about construction loans. Yeah, there's a delay in between when it goes live. So anyhow, construction loan guidelines for sorry, I just for developers and builders. So first of all, construction loan. I mean, most people know about it who are in this industry. I mean, anything from ground up construction for buying a land, you build on it. It's construction, and we need a construction loan most of the time. People don't have cash. Investors don't have cash for the whole project, so they look for construction loans. Sometimes renovation is also considered as construction loan because if the purchase price of the land or the building, sorry, the building, if they buy something for fix and flip and they want to rehab loan and the rehab cost is more than the property purchase price, the actual value as is value of the property, then it's called construction loan because the rehab cost cannot be more than the actual as is value of the property you're buying. Um, the purpose to provide funding for land acquisition, construction costs, and related expenses. Types of construction loans. Land development. Let me just make it bigger. Okay. Land development, um, finance, infrastructure, law development. So a lot of investors, they come to us for horizontal construction. After getting permits, they want to do horizontal. It's before the vertical. So there's a gap in between. So they want development loans. So we help them as well. Construction loans only. That's vertical construction when you're shovel ready to build from ground up to vertical. Construction to permanent. That's also one of the major component of construction loans. If you have no exit strategy of how you're going to get permanent loan, the construction loan is going to be very challenging. So you have to have some sort of permanent loan strategy. Learning objectives in this program or course or the live call is understand the basics of construction loan, identify the types of construction available, loans available. So the stages of construction loan. First is pre-construction land acquisition. We also help in land acquisition as well. up to 50% if the land is ready to go, shovel ready land. And then you can convert that loan into the construction loan. Permitting and zoning, pre-construction agreements. These are the basic pre-construction stages when you start, when basically take the first step. The second step would be construction phase, draw schedules, inspections, budget management. And post construction is loan payoff or conversion. That's important again for us. Certificate of occupancy, once you um, it's a livable space, once you can move in or the tenants can move in. That's what you get, a certificate of occupancy from the city or the inspector. Permanent financing arrangement, as I said, permanent financing is also very important even before you start the construction. Sorry, I'm just trying to see if you're online, because not very technical about these things. Oh, anyways, construction loan products. Number one is private money construction loans. That's what we do a lot because most banks don't like construction nowadays for some reason, um, because construction is a very risky business. And a lot of investors, they don't complete the construction project. They just leave it as is in between. So we do interim construction loan as well. So if your bank is declining your loan and they're asking for the loan back, we can do interim construction loan as well based on the project. What kind of property is it? How much money did you spend? Did you overspend? All those things we have to measure. The second would be conventional construction loan. That's usually from the local banks. Um, and as I said, banks don't like construction loan as much nowadays. HUD 221 D4. That's from the HUD. It's a very good program, but it's a very lengthy process. You have to be very patient about this program. Once you apply, it takes sometimes 9 to 12 months to complete. You can go up to 80% LTV or LTC in this project, in this program, but you have to be really patient. I mean, most investors are not patient. They want money like yesterday. SBA construction loans. That's for um, owner user properties. SBA it can be 7A, it can be 504, depends on the loan size. SBA, we can go up to 25 million under 504, and for SBA 7A, we can go up to $5 million. So it depends on the size of the deal, but usually we focus on SBA 504. And the only requirement, the main requirement, and there are so many other requirements as well, it would be property should be owner user at least 50% or more. You cannot just rent out the property. You can't build a retail plaza and just asking for SBA. Some other conditions apply as well. USDA, it's for both owner user. Just to clarify, HUD 221 is for multifamily properties only. It's not for industrial warehouse. It's for just for housing, urban development. It's a government agency ensuring the loan for banks, just like SB and USDA. USDA for rural properties where the population is 50,000 or less. It's very hard to determine if your property or project is qualified under USDA or not. The only way you can check under USDA eligibility map. And you can under SBA and USDA both, you can go up to 80% loan to cost. At USDA, actually, you can go more, provided when did you buy the land. But USDA, you can go up to more than 85% based on your project. And we specialize in hotels, gas stations, truck stops, car washes. Most banks don't like to lend on these properties. And mezzanine finance. And preferred equity, they're both siblings. They go on second lien when there's a gap in between your sponsor's equity and the debt financing. So, for example, um, you have 65% loan to cost loan, and you have only 15% or 20% equity as a sponsor, as a borrower. So there's a gap. If you're paying 20% down and the bank is giving you 65% debt financing, your gap is 15%. So that's what is mezzanine financing for, or preferred equity. Preferred equity is basically you're selling your equity, and they're usually expensive because they're second lien, like a second TD loans, and usually they're private loans. So let's go to the second page, the next page, eligible asset types. I mean, a lot of lenders doing many other things, or we focus on few things. I mean, quite a few things. Single family residential, 1 to 4 units, can be duplex, triplex, fourplex. Multifamily, 5+ units. Sky's the limit. You can go 100, 200 units. We have investors for those properties, especially under Fannie and Freddie. The loan can be as large as possible. Single family residential subdivisions, like somebody's building 20 homes, 50 homes, 100 homes, 200 homes. We can we can fund on those single family subdivisions. Just so you know, just to clarify, single family residential, 1 to 4 units, we can go up to 85% loan to cost on these properties. Multifamily properties under construction, we can go up to 75 or 80 max loan to cost. There's a bit difference between loan to cost and loan to value. Oh, we'll talk about it later. Single family residential subdivisions, again, 75 to 80%, depends on where the project is and what the feasibility, experience, and everything. Office and medical office. This is, I would say, the least construction loans we've been doing for the last few years, especially for the last 2, 3 years. Not too many investors like these properties. Multifamily would be the best, the top product nowadays. Retail plazas, this can be a good fit as well. There's some product, there's one product we have for retail and or triple net properties where we can go up to like really high LTC, where you have a franchise coming into your retail plaza, for example, and they have multiple units. The franchise has like 200, 500 locations all over the place. And this particular franchisee, they have, I don't know, 10, 20, 30 units already running business in other places. And they have a good credentials, good credit, along with the sponsor, the borrower who is building these units. We can go up to 90%. Sometimes they say it's 95, but 90 would be the best bet if you have all those credentials. Multiple units, lease already signed up, franchise, credible franchise, not declining one. Industrial warehouse is one of the top assets as well. In this case, we may go up to 70, 75% loan to cost. And usually the lending I'm talking about, other than the multifamily, um, usually they're private loans, private money. Hotels, other than, I mean, if you have SBA or USDA, that's a different story. But again, it's for USDA for rural properties and SBA for owner user. And for investors, uh, people who are renting the property out, if it's a city, can't qualify for USDA, can't qualify for SBA. So usually it's private money. Industrial warehouse, that's again one of the top asset types where we can lend on. Hotels and motels, this is usually we go under SBA and USDA. because the LTV is really good, or loan to cost is really good, up to 80 or 85% loan to cost, especially under USDA. But if you don't qualify under USDA or SBA, then we have to have a private money lending. Conventional loans, I haven't done any, to be honest, for the last few years. Most of the deals are going through private or SBA USDA. And the private money is at 65 LTV, 65% for hotels, period. There's no ifs and buts. 65 LTC on hotels and motels. Gas stations, car washes. Again, these asset types we do under SB and USDA. Mixed use, retail on the main floor and apartment upstairs. This is also a very good asset type. Um, and we consider this one of the top assets. We can go up to 80%, 75 to 80% loan to cost. Self storage, assisted living facilities, they're usually under SBA or USDA. Uh, yeah, we're right on time. Halfway in between. So, key question to ask for sponsors. So, what is your experience similar with the similar projects? That's the key point, key question to ask. If they have no experience in any project, they have to have some GC, especially uh, for commercial properties. They have to have a GC or a general contractor with the experience. And we want to see their experience, the sponsor experience, or GC experience, or if they have done how many projects they have done, how have you completed any project in this market, in this particular market, so you know the market. Equity position, how much liquidity do you have? So that's a tricky thing. Liquidity is sometimes not equity position. Liquidity, we ask for equity and interest reserve or surplus money sitting in your account. Most lenders want you to have liquidity sitting on the side during the project, because if the project is running out of money, you have to have some sort of money. Usually it's 5%. They ask for 5% of the total loan cost or total loan amount. The 5% you have to have in your pocket. When did you buy this property and how much did you pay for it? That's a very, very common question. People buy land 10 years ago for $2 million. Now they're saying $10 million. We need to see, doesn't make any sense. If they bought property 2 years ago for $2 million and now they're saying $10 million, it's not going to work. If it's less than two years, most lenders want to use purchase price, not the appraised value as of today. Even though, whatever, you have Amazon store coming right in front of your property, anything happening in 2 years, it's not going to work. You have to have a certain amount of years and proper appreciation of the property. It can't be jumping 5 times in 2 years. There's no hard and fast rule, but that's generally what happens. You have to have the, a certain amount of years to see the appreciation of the property. Project feasibility. What demand studies have been conducted? Um, that's a very common question. Again, do you know if the property is being sold in this area? And how much is the demand? How many tenants out there looking for properties? Are there pre-leased tenants or buyers? That's very, very common and very important questions, because, like I said in the previous page, if you have tenants in place, if pre-leased or LOI or a letter of intent signed by the tenant, that's a win-win situation, because that's going to make your application more stronger. Do you have any financials of the tenants? Is it a franchise? So if it's a franchise, and as I said, it's gonna and a franchise is strong. Its franchise is not declining. It's going upward. It's successful, and the client, the tenant, they have multiple locations. that yes, that your application is going to be more stronger, and you can get more loan to cost versus you have no tenants, and tenants are really bad credit and no franchise, no experience. Yeah, it doesn't make the application stronger. Do you have any potential tenants with the construction when the construction is completed? Oops. Oops. All right. Key question to ask. Okay, where we are at the second here, we are the second set of questions. How much equity are you contributing at the moment, right now? Um, um, oh, I'm just trying to see what happened to the camera. All right, back to the basics. Financial stability. How much equity are you contributing at the moment? I mean, you have the equity already in the land. How much you are contributing right now? Can you provide detailed financial statements? If you have a business of construction, you have done some project in the past. We need to see your financial statements, personal and business both. How are you going to make interest payments in the next 12 to 24 months? Interest reserve, like liquidity. Team credentials. Who are the contractors and architects? What is their track record? Exit strategy, very important. What is your plan for the loan repayment? Most lenders, they want to see what your plan to loan repayment. If you have no plans for repayment, most likely your loan is not going to be approved. Will the loan convert to permanent financing? Like if you have some sort of private lending, that's private lending. They want to see if you have any permanent loan, like um, from CMBS loans or Fannie Freddie or whatever it may be, a conventional loan. They want to see what's the exit strategy, or you want to sell the property. What is the plan to convert into permanent? Any LOI from the bank? Usually it doesn't happen right away, but you have to explain it to the lender that this is your plan, and what is the DSCR ratio, debt to income ratio, at the end of the term. If that ratio doesn't work for the permanent loan, the private lender is not going to lend you the money. So you have to make sure that after the completion of the project, your debt to income ratio is up to the mark where you can get permanent financing. Or you can end up having bridge loans over bridge loans over bridge loans after construction. We have some clients, they come to us, they completed their project 5 years ago. For the last 5 years, they're having bridge loans every year, which is not a good idea because they're expensive. Required documents: personal financial statement to see what's the net worth of the borrower. Very important. Most private lenders, they want to see your net worth equal to the loan amount. Keep in mind, your net worth should be close to or equal to or more than the loan amount you're applying for. That's including the equity in the project, just so you know, the subject project you're doing. Schedule of real estate owned properties. We need to see how many property you own right now, how many projects you have done in the past, It's always on the schedule of real estate owned properties. Tax returns for the last 2 to 3 years. That's usually we don't ask right away, but this is the part of the process. Business plans, business plan, if there's any. It's not very important, but it is helpful if you have a business plan. Property documents, appraisal report. It's important if you have it, or the lender's going to ask for it, order for it after once you decide to sign and move forward. Environmental study, important. Title report, important. That can be done later too. Environmental and title report. First, we need personal financial statement, schedule of real estate own to start the process to see if you're eligible for the loan or not. Uh, Next one is construction documents, contractor agreements, detailed budget. But budget is very important too. If you have the first and foremost things I can tell you right up front: personal financial statements, schedule of real estate own, executive summary is very important. I don't know if I'm missing something here. Executive summary will tell everything about the project. Loan application, credit history. I mean, you can just tell us what's a credit history, but we can do that later. Sources and uses, pro forma. Loan application, executive summary, schedule of real estate owned, personal financial statements, sources and uses, and pro forma. These are the 5-6 things we need upfront to see if it makes sense. Executive summary it's a very detailed information. I don't know why did I not include here. That is the most important thing. Executive summary. It's like a story of the deal. The client started in 1990. They have done 10 projects like this. They have built 500 units. They have done in California, Arizona, wherever they may be. Their credit score is this. This project they purchased in 2018, land for $2 million. They got the permits. They got entitled. They did the horizontal construction. They're ready to shovel. Now the land value is certain amount, $5-6 million. They're looking for $15 million. Liquidity is this. So it's like a story of the deal. Everything on the executive summary. Sometimes we don't need anything, just executive summary to see if they're eligible. And then we move forward for our schedule of real estate owned, personal financial statements, sources and uses, pro forma, budget. Okay, let's move forward. We have only 5 minutes to go. Evaluating construction budgets, land cost. That is usually what investors do. Um, we don't do that. Hard cost, soft cost, contingency. You bring us all the information. Common pitfalls, underestimating costs. That is very usual, especially for inexperienced borrowers or investors. They always miscalculate the costs. Insufficient contingency reserves. They don't have enough reserves to complete a project. As I said, liquidity on the side, and that can be a very big mistake. That's an example of a calculation. Total budget $10 million. That's very basic information. You don't need to know that, but I still go through. $10 million total budget. Land value is $2 million. Hard cost is $7 million. That's a construction cost, and soft cost $750. Contingency $250,000. So altogether $10 million. These are the loan programs we have. Other investors, they have multiple programs, but under residential loan amount would be 500K to 100 million. Actually, it should be $10 million. Most residential single family 1 to 4 units, we can go up to $10 million for single family at the moment. Loan to cost 85%. Rates from 9.99%. Usual term is 12 to 24 months, usually 12 months. Interest only payments, we do nationwide. Commercial, we start from 1 million to $100 million, 65 to 85% loan to cost, 9 to 12% rate of interest, 12 to 36 months of term, interest only payments nationwide. Why I say 65? On most of the private money lenders, they don't want to go more than 65 nowadays. Only if it's a multifamily property, it may go up to 75 for that's under private. If you don't qualify under Fannie and Freddie agency loans or HUD loan or conventional loans, then you go for private. That's for multifamily. But most of the deals, if they're not under SB or USDA, they go for private, and the private money is always 65% loan to cost. May go 70 for it's a great application. Qualifying criteria: minimum 3 projects in the last 3 years. I would say a GC would experience as a guarantor. I would say for the last 18 months, three projects similar. If they're large projects, it can be that time can be stretched. In last 5 years, you may have like $20 million 3 projects, which is fine, but you have experience in the past. Minimum 650 on large projects. Commercial projects, we don't care about the credit as much unless it's bankruptcy or foreclosure or money laundering. No, money laundering cannot be done, period. If you deliberately try to do some bad stuff, that's not gonna fly. For bankruptcy and foreclosure, we need an explanation. DSCR ratio, it has to be minimum 1.0 at the time of completion. So we know there's an exit strategy. We can get the loan done with a private or a permanent lender, and we can move forward. Then the private lender can, or even any other lender would lend you the money. For SBA and USDA, just so you know, the DSCR ratio or debt to income ratio has to be at least 1.15 on the greatest deal. They usually ask for 1.2, 1.25, but 1.15 is the minimum. For private, we can go up to 1. Minimum liquidity 5% for most of the projects. That's not the equity again. That's beyond and above the equity. Net worth equal or more than the loan amount. That's usually for private money. I forgot to mention this private. For SBA, USDA, or other conventional loans, you don't have to have exact amount of money as compared to the loan amount. It can be less than that. As long as you have a strong credit, experience, exit strategy, the debt to income ratio everything is good, aligned, the net worth can be ignored. It can be zero, but if the project if the loan cost is $10 million, I would say $2.5-3 million may work if provided you have other great assets like experience, credit, project you have done in the past, and debt to income ratio. Exit strategy must have a solid exit strategy: refi or sale or permanent financing. Refi is permanent financing. Location nationwide. Conditions apply. Private lenders don't like rural areas. If they're rural areas, we do USDA. And if the private lenders don't like some areas, we do SBA. So it depends on the location. This is a recently closed deal. We are running out of time. Asset type, multifamily property, we did in Houston. 40 units, loan amount is $14 million. Interest rate was 11.5, 70% loan to cost. Total project cost were $20 million. Land value was 3.5. They purchased a few years ago. Soft cost, including everything, 1.5. And the hard cost $15 million altogether. The project was 20. Sponsors equity was $6 million, including the sweat equity and their cash injection. And again, it was Houston, Texas. We closed the deal. This is a good deal, good LTC for multifamily property. So I think we're done. If you have any question, you can contact us at. By the way, company name is Acom Capital. It was hiding somewhere behind this thing. You probably can see it. Acom Capital 619-738-6474. You can email at raja@acomcapital.com. By the way, my name is Raja Man. Acomcapital.com is the website. There's another website, acom-capital.com. You can join us. We're going to be starting newsletters all through the website. We're sending information. Even this video, we're going to be putting on one of the newsletters, and you can see it later. And on LinkedIn and TikTok, we are very active on LinkedIn, and we are sharing information as much as possible for the people who are willing to learn something about it. And also, we are starting a course for people who want to get into this business in commercial lending business. So, all right. Thanks a lot, guys. Thanks for attending. People who are attending on LinkedIn, TikTok, Instagram, YouTube, Facebook. Thanks a lot, guys. Take care. By the way, we'll do another one for most likely SBA or USDA loans next week, same time, Friday, 9 a.m. PST or 12 p.m. EST. All right.